In this part of the series, I'm going to be discussing everything you're going to need to know about buy-to-let mortgages. Welcome back to the second episode of the series. If you missed the first episode where I discuss everything to do with setting up your property business, make sure to check it out and I'll leave the link in the description. In this video, I'll be talking everything mortgages, how to finance a deal, how to remortgage to reinvest, and the lender's requirements. The best thing about using mortgages to buy property is you can use it as a form of leverage. So what is leverage? So leverage is where you use debt or borrowed capital to invest in assets. It can also provide a great foundation for building your own generational wealth by using other people's or the bank's money, which means that your money is going to go a lot further with the help of leverage rather than having to purchase the asset using all your own cash. A good example of this is a mortgage. So let's have a look at an example of using one to buy a £100,000 property. So what you can do is marry up your own capital of typically 25% of the purchase price, which in this case is £25,000, and the bank's money as a loan of 75% of the purchase price, which in this case is £75,000. So you will, however, have additional fees to your deposit. So as you can see here, you typically pay a 3% stamp duty charge to your purchase price, legals for your solicitor, mortgage broker fee, your valuation on the new property, and the surveys, if applicable, independent legal advice if you're buying for a limited company. So as you can see here, our deposit and all our fees in the property is massively leveraged by the bank's loan. So you can't leverage your money in other strategies like crypto or stocks, as banks view these strategies as too volatile. However, banks view property as a very good, safe and proven investment strategy, as properties have capital appreciation over time and rent which will pay them back the mortgage interest. Therefore, banks are willing to lend you their money towards your investment. So what type of mortgage can you get, and which mortgage do most investors use? You can get an interest-only mortgage, whereby you only pay the interest of the loan back to the lender each month, or a repayment mortgage, where you're paying back a portion of the actual loan back to the lender alongside the interest. So most property investors use interest-only, as they're a lot cheaper than repayment mortgages, so the surplus money can go towards buying your next property, marketing or education towards a strategy you want to carry out.
Having a loan that isn't getting any lower can be a scary idea, but most loan terms are normally 25 to 30 years. Therefore, you can keep remortgaging decades into the future, so it means with inflation, the debt will be eroded over time and your equity in the property will increase. Or, if you want to fully exit, you can sell the property and pull the capital out that way. The next thing you might want to consider is, do you want a fixed, tracker or variable type mortgage?
A fixed mortgage product is the most common type, where your monthly repayments will remain the same until the fix ends, normally on a term of 2 to 5 years. You can get a tracker rate mortgage, which unlike a fixed rate mortgage, the payment can change depending on the interest rate. So for example, if the Bank of England interest rate increases, so will your mortgage payment. This will usually be a 2 to 5 year mortgage term as well. And the final type, standard variable rate or SVR. So this is normally an increase of your interest rate once your initial deal on your fixed or tracker rate comes to an end. So most mortgage brokers will want you to remortgage before you drop onto the SVR.
Another thing you'll need to be aware of is, if you're looking to leave your mortgage product early within your fixed term, you may need to pay early repayment charges. Early repayment charges is where the lender will charge you a percentage of the loan amount if you choose to exit the product early. This percentage usually decreases for each year you remain on the mortgage product, so bear this in mind if you're looking to remortgage.
So let's have a look at an example how you can remortgage to reinvest into more assets. So using our £100,000 property, we've got a £75,000 mortgage on it, but you can actually increase the value of the property by adding a new kitchen or bathroom, adding a new bedroom, or creating a new parking space, or you can wait for the capital appreciation over time. We may then get a new revaluation of £150,000, which means that you can get a new mortgage based on the new valuation, which 75% is £112,000. You can then pay back your existing mortgage of £75,000 and you can pull out £37,000 to invest in another property. Okay, let's have a look at the requirements you're going to need to attain a buy-to-let mortgage. So this section of the lender's requirements is a very general guide and based on my own experience. So all these factors here will vary depending on your own circumstances. So make sure to reach out to an independent, experienced mortgage broker, as they'll be able to help. First thing you're going to need to know about buy-to-let mortgages is it's not all about you like it is when you're buying your own residential property. For example, when you're looking to buy your own home, lenders will normally let you borrow 4.5 times your income. However, when you're looking to get a buy-to-let mortgage, it's more based on the property. That being said, they do still look at your income and your credit history. So like I said, it's a very general guide, but this is normally what the lenders look for when you're looking to buy a buy-to-let property. So generally speaking, it's easier to get a buy-to-let mortgage if you've got your own residential property or you've got a buy-to-let already. Some lenders, but not all of them, look for a £25,000 income threshold. The rental coverage will also depend on the lender, but most lenders want to make sure that the rent is 150% of the mortgage payment. Another thing that some lenders like to see is that the property is worth at least £40,000 to £50,000. Some lenders loan up to 85% of the value of the property. That being said, I'd advise that you stick to 75% products to allow for fluctuations in the market. And finally, if you're buying the property for a limited company, the lender might want to see a personal guarantee from the director of the company, which means the guarantor is personally responsible for repaying the lender if the business fails to do so. Like I said, this is a very general guide, so make sure to speak to your own mortgage broker. I'm actually filming a podcast with my own mortgage broker discussing all this in more detail. So if you're interested in seeing that podcast, make sure to click subscribe and hit that bell icon so you don't miss it. When you do speak to your broker, here's a list of documents you're going to need to give them a good understanding of your position and the property you're looking to buy. Latest free wage slips and P60, latest free bank statements, proof of ID, proof of address and proof of funds, and an idea of your target property. So that's it for today, guys. I hope you enjoyed this episode. Next week's episode will be everything to do with finding, analysing and valuing properties. So if you want to watch that, make sure to click like, subscribe, and I'll see you next time.